So good morning, everyone. Thank you for joining us for today's webinar. We are recording this, so if you do miss any part of it, we will be sending that out after the event. And I know we've got some people who couldn't make the live time, so they'll be watching the recording later on. My name is Summer. I'm the Projects and Events Manager for MPAQ, and today I'm just moderating the webinar. And today we're going to be talking about budgeting for a plumbing business. So budgeting is about setting clear profit goals, understanding the performance needed to achieve them. So a well-structured budget acts as this blueprint, guiding decisions, helping anticipate potential cash flow challenges. And we're joined by Daniel from Exact Accounting today. Hi, Daniel. Daniel has over 10 years of experience in the commercial and industrial field in various senior finance and commercial roles. So we're lucky to have him here with us today. If you have any questions throughout the session, pop them in the chat and we'll come back to those at the end, or feel free to do the little raise your hand button, and yeah, we can come back to you. And that's pretty much it for me. So I'm going to hand over to Daniel. Thanks, Daniel.
Yeah, that's awesome, Summer. Thank you very much. And yeah, very proud to be here presenting with Master Plumbers today. Thanks everyone too that has carved out a bit of time, obviously, for this webinar. There will be a recording at the end, but please definitely make the most of it. I mean, obviously you guys have carved out time. I've carved out time. Yeah, feel free to chuck in hard, curly questions into this presentation. And yeah, happy to answer any hard questions that you might have in the background. So without further ado, I might launch into it. And thanks in advance, Summer, of your help with this one. So this webinar is all about budgeting for plumbing businesses. So I thought I'd just talk a little bit about us first over at Exact Accounting. So we are specialists in building and construction. So there are plenty of tax accounting firms out there, like there are 2 other accounting firms in this building, even for us, but we niche out and all we do is we chase the built environment. So that means not only just building construction, but we chase anyone that helps contribute to a building. So it might be plumbers, trades, electrical. I've got a couple of turf farms that I look after, could be an architect or anything like that. And we have a deep specialism in that. And the theory behind that is if you specialize, you get pretty good at it over time. Just to tell you a little bit about our services in there too. So we don't just do the tax side, but we have upstream services, which is bookkeeping. So we have a pretty decent bookkeeping division in the background that specializes in building and construction, very good at Xero, very good at MYOB and a few other, I guess, software packages out there. They also get involved in ServiceMate and a few other items too, but highly specialized in that B&C space. We also have your standard tax compliance. Now, they are very good at tax returns, BAS, GST, QBCC compliance. We have a very, very deep specialism in there. I don't look after any of that stuff because I'm not very good at it, but we have some very large tax teams here and a fair bit of talent here trying to remove a bit of the bias aside as well. And then the final division we have over here, over at Exact Accounting, is a division called CFO Advisory, which is what I look after. So I'll probably tell you a little bit about me, a little bit about my background, because I probably walk and talk a fair bit different to your sort of standard tax counterpart. So my background is big business. I've done time at Cleanaway and Bunnings. And before I jumped across to, I guess, Exact Accounting, I was CFO for a labour hire business that turned about 80 million. A little bit about CFO Advisory as well. And I'll just try and polarize, I guess, us and I guess my tax counterpart there a little bit. When you bump into your tax accountant, they are all about the rear vision focus. So they're going to look at what's happened in the past. So it could be tax, BAS, GST, a bit of structuring advice, but everything, the event has happened. They obviously provide a bit of structuring advice into the future, but it is all historics, GST, super, all that sort of stuff. Now, when you bump into a CFO advisor, or commercially, commonly we're called commercial accountants as well. The CFO stands for Chief Financial Officer. Every large organization has a CEO, which everyone knows about, and then their right-hand man or woman commonly is a CFO, which stands for Chief Financial Officer, and they are all about systems, growth, strategy, budgets, margins, forecasts. Dan, I want to double in size. How do I do it? And we are almost the polar opposite of a really good tax accountant, and we look into the future. So just a bit of forewarning, guys. If you put any tax questions in this, I'm probably going to disconnect or poke my eyes out just because I just don't care about tax and super. I want to make sure you lodge on time. I'm probably a 3 out of 10, but my world is the complete opposite. So please hold your tax questions for the right people. So pushing on further in, what is our agenda overall for today? I want to build a bit of a business case for budgeting as to why it's important, why you should consider it, because it can be a really, really powerful tool that you can implement in your business as well. I mean, it's an early warning sign system. It gives you a bit of a pathway as to what's going forward, sets goals, targets, and all the rest of it. Once I build the business case, we're going to go over the tool itself. So there will be a tool to download at the end of this one. So there'll be a QR code, you can scan it. The webinar will come out with it as well. And you can get your access, I guess, get their hands on the tool that I am producing in this space also. So we'll spend quite a fair bit of time in this, and that budgeting tool is going to be lensed in two different ways. One will be focused towards, I guess, like the residential maintenance plumbing section, because the way they budget should be a fair bit different to how a commercial and industrial business budgets. Say you're building a KFC or you're working on a industrial space, the budgeting process is quite different, and so the drivers to profit in that space. And then, guys, please smash in questions. The best worst question can have an hour free session with me. We'll pick it at the end. We'll obviously go to a vote, but yeah, the best question I get, one-on-one session with me for a good hour, and we'll go from there. So I just wanted to talk a little bit about how this comes into, I guess, our overall stack for how we assess a business, how a business comes together, what are the drivers and what are the tickers. So in this screen here, we're looking at our overall drivers, or I guess pillars for every business. So we have our process stack, our platform stack. So what systems are you operating on? And then the reporting stack as well. And then I wanted to lens this and go, well, the topic that we're covering today, even though it's a budgeting tool, all these elements here interact with it one way or another. So it's just the colored items, but I mean, to build a budget, we have to know our sales funnel. We have to know how we're estimating and how we're quoting. We have to know our markup and margins in the background. We need good bookkeeping processes. Otherwise, how do you measure yourself against good budget? Because if you just grab a budget and have last year plus 10%, it's going to be rubbish, to be frank. It has to be full of science and evidence and facts. And then we're talking about the platform that we report out of. So is it ServiceMate, or is it something similar, Simpro, whatever it happens to be? And what's the bookkeeping platform? How does that interact with this process? And the final piece, assuming you have good data, good processes, you know your margins, well, how do we report on it? Because reporting is your scorecard as to how you are performing as a business owner, and I guess how the business is performing overall. So we'll be touching on sales, estimating, bookkeeping, and job costing. There'll also be an accounting and bookkeeping piece, and then the reporting piece. Because it's all well and good to jam the numbers together, but if you can't tell a story behind it, or if the numbers don't make sense, you're going to put it in the top drawer pretty quickly and not touch it again. So when we get to the reporting side, can we tell a story with what's going on? Are we on track, off track? Are we hitting the margins we're trying to hit? And if we have any holes and gaps, what do we do? So we'll try and give some practical examples in the background here where if there are gaps, what do you do? Because it's all well and good to jam the numbers together. That's the easy bit. Well, it's what you do with that information. That's the hard bit, and that's what a good CFO sort of helps coach you through with in the background as well. So why do we budget? I just wanted to lens this a little bit here as well. So before we jump into the detail, what you're looking at here is some insolvency data that has come directly from ASIC and is plotted out by the number of insolvencies by the last sort of few financial years in here as well. So, well, I guess calendar year. So we have January 21, the number of insolvencies by, I guess, major trade, major pillar in the economy. So construction, accommodation, other services, retail, professional services, etc. And the bottom bar is the current calendar year, the number of insolvencies the year before. And I guess the ironic thing is, I mean, this is ranked number 1 to number 10, number 1 obviously being the worst. And it's ironic here, like if you sort of do the backyard barbecue conversation, speak to friends or family or look online, people say, no, don't get in hospitality. It's a nightmare, don't do it. But the ironic thing is, and the unfortunate thing is that, well, when you pop the hood and look at the data and evidence, not the hearsay, you can see pretty clearly here, accommodation and food services, which is essentially hospitality, their insolvencies have been 824 to date. So that's either large businesses or, a lot of these are family-owned businesses as well, where they just can't make the numbers work and stack, and they have fallen over, which is very sad. But when you compare that to building construction, unfortunately, it has the number 1 spot, and it is compounding year on year as well. So I'm not trying to generate any fear with this. I'm just trying to generate awareness around this too. The facts and figures saying, there is a bit of turbulence on at the moment. Big ones and small ones are falling over. But what I'm trying to say is that if you know your facts, your figures, your data, you know where your business is going, you know how many sales you need to make sure your business is operational, you know how much margin you need at what point, what your utilization rates are for your individual plumbers and the like, you can generally sort of steer yourself out of this hurt. But if you're flying blind and you don't have that financial clarity and you're managing your business by your bank account, you are in a lot of danger. You know, I see this and have this conversation a lot, but you can be a large portion of the population that are steering themselves out of hurt. We have plenty of plumbers on our books that are on the onwards and upwards. But if you're flying blind, that's where a lot of the hurt will come from. So what do we usually see? So commonly what I do see out in the market is a bit of a profitless boom going on. And I have heard it on the media and from a couple of other coaches as well, is there is plenty of top line growth at the moment, especially along the East Coast and the Northern Territory, if you're in that commercial space with what's happening in China and all the rest of it. But there's still plenty of building activity all along the East Coast. Victoria is sort of getting a little bit quieter. New South Wales has a bit on, and Queensland's still going nuts at the moment. But I'm not seeing a lot of margin, a lot of profit coming through with all that effort. It's easy to pile in a lot of top line revenue, sign this and sign that, and go to the next real estate agent, sign them on, et cetera, et cetera. You sort of lower your price because you get a little bit fearful around not winning the work, and then not a lot of margin pops out of the bottom. So I'm seeing a lot of top line revenue strap in, but I'm just not seeing shareholders and owners and families get the returns that they need and want. So there is plenty of that on the go. I have a lot of conversations around margin. So when I say margin, I'm talking gross margin. So to be honest, I don't really care too much about overheads, because once a business is in a fair bit of financial hurt, people measure overheads because it's easy. Cut a phone plan here, cut a phone plan there, and you cut your, well, I guess you manage your overheads to within an inch of their life. But I promise you, where you're going to make your money is understanding gross margin. So just to be clear around gross margin, it's revenue minus direct costs, and one minus the other is your gross margin. Then you take off your overheads, and then you have your net margin right at the end. So I have conversations all the time, and I reckon maybe 8 times out of 10, 9 times out of 10, I'll say to a plumber or builder, I'm like, oh yeah, what are your margins? What are you making? Because I need to know that as a CFO advisor. And they'll say, oh yeah, I'm making 30 or 40% in the plumbing space. I go away, pop the hood, look at zero, and it's 10, 12, 8, sometimes even smaller, or they're underwater and they don't even realize it. They pop open zero, have a look, can't understand it. Numbers bounce around all over the place and go, oh, look, I make 30%. Well, rubbish. I'm just not seeing that at the bottom line. So just be really, really careful around that. It's all well and good to say, hey, I won this project at X dollars, but I want to know what the margin is. And then can you defend that margin all the way through? So when the dust settles, did you make that money?
Sorry, Daniel, can I just jump in? Heath
Please.
has a question. Heath, did you want to
ask hey, now? Daniel.
Yeah.
Just a really quick question on direct costs. Can I confirm that when you talk direct costs, you're talking staffing and materials?
Yeah, so there's a really, really, really important concept here. I sort of call them earners and burners. So if you have people on the tools creating value, like as in the product itself, so you have the plumber, the materials, the sub trades, the site supervisor. If you're roaming site to site yourself personally, from a project management point of view, part of your wage is a cog or a direct cost. All that is a direct cost. All the other stuff, so your burners, so like me, for example, I'm a burner. If I was in your business, admin, rent, all that sort of stuff, utes, stuff like that, they're overheads. So you need a really clear delineation between the two.
Okay. If vehicles are actually part of committing that service or delivering that service, you wouldn't include them as a direct cost, you'd still leave them as overheads?
Well, yeah. So for example, if you have like a couple of vac trucks and all the rest of it, you absolutely need to have those in cogs, 100%. Okay. Yeah, definitely. Okay. Yeah. So like run around utes, or so not tool or trade utes. So if you have a plumber that needs a ute that has a gear on the back, that's a cog. But if you have a Hyundai or something, for the admin person or whoever it is, that's that is an overhead. Yeah.
Yeah. Cool. Thanks, mate. Appreciate it.
Yeah. No, great question. Great question. I probably should have articulated that a little bit better, but yeah, it's really important to get clarity on that, and I'll talk about that a bit more on the tool. Any other questions on this, Summer? Or am I okay to sort of push on?
Yep, no, all good.
Yeah, okay. The final thing I sort of see really, really commonly as well, and it was a bit of an eye-opener when I sort of I guess where I had come from large business and sort of coming into that sort of small, medium space, but there's still plenty of aches and pains in there, is where people look at the profit and loss statement, it doesn't make sense. There's a big loss one month, a big profit another month, and 2 months of losses, and then December and January losses. people get frustrated because they can't understand the number, understand what's going on. So they go, oh, look, I'm going to park that. I'm going to manage my business by my bank account. And I call it the back of the beer coaster profit performance tool. Managing your business by your bank account and going, oh, there's plenty of money in there. And then you do a creditors run or your BAS bill comes in. You can't run your business that way. And sorry to those of you who do, but hopefully there aren't many. What you do is that if you have a good profitable business and you micro measure it all the time and you are generating profit, well, a byproduct of that is that you generate surplus cash. So if you have that financial clarity, understand the numbers, cash as a byproduct always works out, pending a tremendous debtor falling over or, some sort of, weather event, whatever it happens to be. So if you're managing your business by your bank account and you don't understand the P&L or it bounces around too much, you absolutely have to change that mindset. Because if you think about businesses that are, 4, 5, 6, 10 times bigger than you, the philosophy behind this is introducing big business thinking into smaller businesses, and that's how they scale. Every big business manages their business by their P&L on their balance sheet, and cash works out. The final piece as well is, and I'll push this a little bit quicker too, is I'm sort of seeing this mindset around the whole fake it till you make it. A lot of people where they are in a little bit of financial distress, they don't talk about it, they don't share it, and they sort of wait till it gets to the pointy end. Conversations, the stress at home might be a bit hard and all the rest of it, but you might pop open Xero or Deputy or Serviceman. I've got plenty of work in there, stuff might be okay. I sort of call that, I guess, the fake it till you make it concept. I mean, it's easy to sort of pop open a P&L and sort of do a back of the beer coaster and push this across and push that across, and that claim's coming in a different time, and this guy's going to start and generate this revenue. Just be really careful of adopting, I guess, a business principle mindset around that. If you have your facts, you have your figures, you have your data, you have your budget, which gives you your forward view, you will generally be okay. I mean, minus a catastrophic event. Don't just do the stitch together, the add in on the back of the beer coaster. These claims are coming in at this point. Have good data, have good evidence, have good financial clarity, have good reporting, and make sure that, I guess, the numbers tell your story. Don't do the fake it till you make it. Don't spot check Serviceman and spot check this and go, oh yeah, it feels right, smells right. Definitely get some science and evidence and data behind that one. So why do we budget? A budget, I'll probably contextualize this a little bit to the family trip. So if you're in Queensland and you're going from Brisbane to Cairns and you want to do a road trip, you'll gather the family and go, how much money have we got to spend? These are the stops that I want to do. This is the money I want to spend along the way. Here's a budget for fuel, and away you go. And then if you hit Cairns and you've had more stops and spend more money on dinners and restaurants, you go, hang on, I need to pull that back. So I only got X amount of budget pot to apply to that. And people I generally bump into are usually pretty good at it. We've got a budget of $5,000, $10,000, whatever it is, and people stick to it. The philosophy behind that is that you measure yourself against your budget, you measure yourself against the plan. If you're overcommitting, you pull back. If you get towards the end of the holiday, you got a fair few extra dollars, you can be a bit more lavish. Budgeting for any business is super, super important, and it adopts exactly the same concepts as well. So if you have a really good budget, you will plan and map out your revenue, your COGS, when you want to buy a vehicle, when you need to bolt in the next person, what's the utilization rates, where does that land? Hey, this commercial project's ending here. We have a vacuum that's going to come in April. If you put a lot of science behind it, it is a very, very powerful tool to help you keep on track. Because at the end of the day, I mean, if you're going to grind out another year, surely you want to know how much money you're going to make. Or if you forecast in your current commercial projects, these are the times that they end, you can actually reverse engineer how much sales you have to go chasing, or, what's the size of the next project you need to hit. So it becomes a really powerful tool, and I guess like an early warning system for where you are coming into a fair bit of hurt as well. So you could have a hole in a project, and because, there might be plenty of work on the go, you might have 4 or 5 builds on the go. I'm talking from the industrial space now. You'll go sprint, and go, oh, this handover's in 2 weeks. Oh, I've got nothing in the barrel, and I've got 7 guys I need to keep fed. So as long as you're sort of looking at it frequently, and you're measuring yourself against it, and you're keeping yourself accountable and all those other good things, you'll be all right. And the final piece is, well, once you've sort of built a budget, it works, when you need your next sale, when you're going to bring on your next 2 or 3 hires, all that other fun stuff, well, it becomes your scorecard. And you measure yourself against the scorecard. So you have this 12-month budget, and you get to the end of the month, you do your accrual accounting, you make sure your numbers are right, you push in your work in progress, if that's appropriate too, you go, well, am I on track? If you're on track, and at least from my view, from your CFO's view, if you're hoping to make $40,000 this month, after you pay yourself a wage and the business comes in at 42, well, great, high fives and hugs, well done, let's talk strategy. But if we were budgeting to hit 40K for the month and you come in at 6, well, guess what? We're going to turn up the intensity and go why until we figure it out. So it could be a process, system, people problem, accountability problem, whatever it happens to be, and go, right, how to correct the ship, because we need to try and claw back that, I guess that 34K gap next month. So it gives you a roadmap, it gives you a plan, and if you do it right, it takes a bit of the guesswork out and fear out, and you'll sleep better at night. Absolutely. So plumbing is a pretty broad area, and we have all sorts of people on our books, which I'm pretty proud to say. But I can probably, I guess, generalize this into 2 major categories, and just the accounting treatment and the commercial thinking behind this is a fair bit different between the 2. But I have built a all-in-one budgeting tool for plumbers here, and I've broken it into 2 sections. One is major commercial projects or industrial projects. So that's stuff like, I don't know, you say you're doing the plumbing system for a KFC, or you're doing the, I don't know, the engineering underneath pipe work laying, for a major project or a shopping center. That is big commercial stuff, and commonly it's lumpy revenue. You do stage claims more often than not, or like an end of month stage claim, and a QS goes through and tallies up your percentage completions. That is commercial and industrial budgeting. The other side of this as well, where I think is where a fair few people are sitting, but if you're interested in the commercial projects, definitely listen on, because there's some pretty important concepts in there. But the maintenance residential side, I think, is where I guess most of the meat is, I guess, for the purpose of this budgeting tool. So that includes people that do emergency call outs or do work for residential businesses, or rental agencies, et cetera. So your revenue out of that is less lumpy, it's more due and charge. So come out, change a pipe, change a fitting, I guess, serves a toilet, whatever it happens to be, and it's a fixed fee, spot fee, and hopefully it's due and charge at the same time. So they're the 2 broad areas that we will cover in this section now. So bear with me just while I change gears, and I'm going to jump into the tool now. But any other sort of questions before I launch in? Awesome. All right. Bear with me. So we'll do a bit of a big questionnaire at the end, and just bear with me while I run through this. So this tool is going to be available for everyone on the call. It's free. There's no hooks. There is plenty of substance in this. If you're not too good with Excel, don't freak out. Like it is hard to break these. Save it frequently or save it at intervals. I strongly encourage you just to get in and have a bit of a play with it. I mean, it's hard to break. A couple of key components in here just to be a little bit careful of as well is that if you do click into any of these cells, and if there is like a long complex string or it's a formula, generally don't override those if you can, because they are linked to other drivers, and I'll talk about that very shortly. If there are, I guess, user entry fields in there, the spreadsheet will call it out. But yeah, again, this will be available for everyone. So the big thing about this, make sure you guys own it, personalize it, drop your logo on there, make sure it sort of feels familiar, drop your business name in there. It's all print ready to go. Once you have done it, print it out, stick it on the wall, stick it somewhere, and do make sure that you do look at it and measure yourself against it and keep yourselves accountable for it. Because at the end of the day, I mean, you want to know how much money you're going to make out of this thing. Well, I do. So why not forecast it out and go, hey, hun, or better half, whoever it is, if we get this right, well, this is what we're hoping to make out of it. And your tax guy or girl will love it. Hey, with tax planning, we're at February, March, April. Here's our forecast the next 3 months. What do we do? So there's so many downstream wins from this. Okay, so coming into the substance of this is a 12-month budget. You're welcome to sort of substitute out the months for other months. So if you want this to be a rolling budget, whatever it is, but we do try and do it like a fixed budget. And I would encourage you to do it inside the financial year, because everyone talks financial year numbers and the like. And this here is a pretty bog standard P&L, and we have generalized this, I guess, across the board for a best fit. And these are all your months across the top. Here's your total column over here to the right-hand side. I've got dummy data in this as well to sort of help you guys along when you do get it. You're welcome to clear it out. And with the income side, we've split it between commercial projects and residential projects. So you'll notice down the bottom here, there's like a projects commercial or industrial. So these 3 tabs here will essentially feed into the revenue side here, and they'll also drive the cost of goods sold, COGS. Just a quick one on that too. I mean, you might hear some accountants and business people talk about COGS and direct costs and cost of sales. It's all the same thing, exactly the same thing. So don't let that sort of bamboozle you. It's the same term. You know, they're your earners. So commercial projects feed off these couple of tabs here. Residential maintenance, you know, they sort of fit off these two here, and they have different drivers in there. If you're a commercial only, I mean, you're going to see nothing in this section here. If you are residential only, commercial projects will zero out. So, and then as you go a bit further down, it tells you what your total income is, what your total cost of goods sold are, and then one minus the other is your GP. And I'll talk about GP targets throughout this as well, because there should be some targets you guys should be hitting throughout in this too. I mean, if you're in the resi space, it should be in the 40s, 50s. In that commercial space, you should be chasing about that 20, 25, 30, to be frank, depending on the type of business. So if you want to ask any curly questions like that, we speak to a lot of them. Our sample size is pretty good. Just shout them out, please. So coming down a little bit further as well, you do get a couple of free kicks from the government too. You know, so you might get apprentice rebates, or you might get a tech incentive handout from the government if you roll out some IT software, or whatever happens to be, some steel rebates for anything that you dispose of. Do drop these in here. These here are all free text fields. And look, to be honest, I would spend 2/5 of almost next to no time in this section, but it is part of your business. I'd rather you spend, you know, 10, 15, you know, probably 20 hours up new COGS and revenue. And for every 20 hours, I'd spend half an hour on your overheads, because you're not going to move the needle on overheads. I promise you that. So GP, so gross profit, GP, gross profit, same thing. Gross margin, same thing, guys. So I'm just trying to just demystify that a little bit. There is a difference between gross profit and markup, so be a little bit careful about that, and I'll talk about that a little bit later. But gross profit is revenue minus cost of goods sold is gross profit. Now, with gross profit percentages and percentages that you hear accountants talk about and business owners, there's nothing too scary about this. What gross profit percent is that what is the ratio of $1 coming into your business, and how many of those cents per dollar do you keep? So the formula is, well, revenue minus cost of goods sold, direct costs, that gives you gross profit. And then if you do gross profit divided by revenue, that tells you how many cents per dollar do you generate as GP. GP, gross profit, gross margin, same thing. So super, super, super important concept there. And then you go, well, how many of those cents on the dollar do I have to tear up and burn on overheads? Now, this isn't a perfect example. I've just dropped in some dummy data here, but you go, well, out of that 23 cents up here, or 31 cents, I'm spending 7 cents on overheads, and I'm making 25 cents at the bottom line. So just a bit of a rule of thumb for you guys, whether you're in the commercial or industrial space, if you should be paying yourselves a decent wage if you are in the business, you know, 120, 150, whatever happens to be, depending on your size and scale. But at a minimum, so if you're going, hey, Dan, I want you to invest in my business, I want you to chuck in 400K and I'll give you 10%. My feedback's going to be, if this here isn't 12% plus, I'm going to tell you you're dreaming, or you're not getting my money. If you're up in that sort of 15%, or if you're in that resi space, you know, probably closer to 20%, you know, go, yep, then I'll chip in some money and, you know, I'll be a silent shareholder. So they're the questions you need to ask yourself about this, particularly when you're building a budget. You know, if I was being a silent investor in this business, would I invest in this business? And it doesn't have to be a complex question, because if you're only making 2% down the bottom, you could be making 100 grand a month in revenue, or 500 grand a month, but you're only getting a 2 or 3% return. It's not very sexy. You get better returns from the bank. So they're the questions you need to ask yourself along the way here in that process. So just to reiterate, income, commercial, resi, cost of goods, and we'll get to the drivers on that in a second. One minus the other is your gross profit. All these percentages. So whenever people talk percentages, just think it's just this number divided by revenue. Divide by revenue, divide by revenue, divide by revenue every time. You know, people say, what are your cost of sales? Percentage, just cost of sales divided by revenue. What are your overhead percents? Overheads divided by revenue. It's as simple as that. Other income, but don't burn too much time there, but put in apprentice rebates, steel rebates, whatever happens to be. Overheads, build these out, but that should be pretty quick and easy. And then down the bottom is your net profit, and you're chasing 10% plus, 12% plus.
Hey, Daniel, can I just ask another question? And sorry to interrupt.
No, please.
To confirm, the gross profit target that you're chasing, you know, for resi, I think you said around 40%, our commercial is a little bit less.
Yes.
To achieve that result will be a mix of the markup we put on our labor cost and a mix of the markup we put on our materials cost.
Yes.
Yeah, and whatever is left out of that, whatever we mark it up, and whatever we left is what our gross profit is as a dollar, and then we convert that to a margin. But it's the combination of those two things.
Exactly right. Exactly right. So commonly what I see in this space, and again, you guys will be the experts. I mean, you guys know your trade better than me, but commonly your average markup, so different to margin, your markup on materials needs to average in the resi space or the maintenance space needs to average about 100%. Now, if you do a bucket load of hot water systems, all the rest of it, I mean, you can't basically double the price and charge it. So for example, the hot water systems, you might drop them down to sort of 15, 16, 17, 18% if they're $5,000, $10,000 a unit pop. But all those elbow joints and pipe works, they're 200% all day. If you buy something from Reese and it's $6, you'd make it 12, 18 bucks. And that's how it works. And the average of that, to your point before, absolutely. Yeah, sort of needs to land around about a sort of like 30, 35%.
Okay, and then we've got to include what our markup is on our labor.
Yeah, exactly right. Exactly right. So that can run anywhere between sort of like, I guess, 40 and 50% on there as well. But keep in mind too, I mean, markup on labor needs to be inclusive of all your overheads on that labor portion. So it's not just the gross wage, but it needs to be gross wage plus the plus work cover. If you're lucky enough to pay payroll tax, add that on there as well. Yeah, so you bundle that together and then you apply your markup percentage on that one as well. So there's a whole separate tab on that too.
And you could throw vehicles, the plumbers' vehicles into that as well, because that's a direct cost as well.
Yeah, I would build that up in there. I mean, we're probably sort of edging into estimating and that sort of space now. But fair question, keep throwing these out, and we've got a bit of time at the end. We'll definitely rip it apart. Or if you want to have a yarn, there'll be a QR code at the end, mate, which we can have a catch up on that separately because we've got quite a bit of expertise in that area. But yeah, as far as like the estimation side goes, as far as what's on a job and what's included, I mean, there should be vehicle inclusions. If you've got heavy duty tools, vac pumps, whatever it happens to be, there needs to be a rate of return on that. How many hours you sweat in that asset? What about the person? If there are consumable tools inside, there should be an allowance of that as well. All that sort of stuff in there too. Rain days, utilization. Yeah, so there's quite a bit of ground in that. So those later bits are probably for a separate session, or we can catch up. But yeah, definitely need to be considered. Absolutely. Good question. Good question. So I imagine everyone here is pretty familiar with the P&L and how it works. Now, I might just jump straight to overheads because that's the easy portion here. Now, when building these out, we'll go straight to the right-hand side, and there's an overhead section here. And we'll come across to the right. And now there are a lot of tabs here, guys. Don't get scared of it. Just jump in, have a play. If it breaks, close it down, open it again. But there are a few prompts all over the place as well to sort of tell you what's going on and where the data comes from as well. So the easiest way to build out your overhead section is in this section here. What I do is I just jump into Xero or MyOp or whatever it is, just dump out a P&L, copy and paste it. So just grab that overhead section and just copy and paste it into this column here. Just a straight dump. Now, I've limited this to about 22 rows. If you're one of those businesses that have 40 or 50 overhead rows, stop it. It's too much detail, too much noise. Don't. Try and get it to about sort of 20 or 30 lines. If you're a monster business on here turning 100 mil, different conversation, but just keep it tight in there. You don't need bucket loads of rows. Now, in the next section over here, what happens is that once you drop in your current chart of accounts or your current overhead section, accounting, bookkeeping, etc. For those of you that love to build out the detail, this will all self-populate. So you'll see here accounting, bookkeeping. Then what you can do here, you can go, well, with our accounting services, you might have audit insurance. Whatever it happens to be, this is $60 a month. And you'll notice that this here, the formula picks up across to the right. Any of these sort of like beigey, creamy colored cells, feel free to overwrite. But spend a bit of time building these out. What do you spend on bookkeeping? What do you spend on advertising? This here will build around your current chart of accounts. So it's not like you're going to have 50 empty rows and you go, oh yeah, that's useless, that's useless. This will be built around your current business. So hopefully you get a bit more substance and depth out of it. So when you are going to this, what I would recommend doing is going, well, build out your subscription stuff first. So it could be tech, systems, any subscription-based models you have on the go, build those out. You might have an amount that you want to spend on advertising. So Google AdWords, you might have SEO in there as well. What do those prices be? Build this out. And then what I do for like July, August, September, October, November, when you build this out, get to the bottom and go, how much am I spending on overheads? And then compare that to what you are spending at the moment. So if the bottom here says it's 10 grand a month, but your overheads in Xero MyOp says 40, well, you got a bit more work to do. So just make sure you just crap check these numbers a little bit. Do that make sense? Are they reasonable? Because you don't want to get to the first month where you're measuring yourself against your budget and you're miles out. And you go, oh my God, this is too hard. So just be really, really, really mindful of that. So spend a little bit of time building this out, but once it's built, it's done. I mean, it's rare that overheads change monstrously. You might add a person in, you might move office once every few years, but this should be fairly steady. And keep in mind, for every hour that you chuck at this, or half hour, I probably want you to spend 20 hours working on COGS and margin and revenue, et cetera, because you won't move the needle here. So as you do build this out, some of the numbers will come across here into like a nice little summary, because then it'll reflect what's going on in your ledger. You can see what's going on as far as the spend patterns go. You can override any of these. You won't break it, so don't be fearful of that. You can change this to 15,000 if you want to, and hopefully this will update over the side there, 15,000. So go nuts with it, make it accurate, make it yours. Now, the other piece which is done separately, you might have noticed on this other page here, salaries and wages are separate. So we talk about overhead employees. So this section here are just for your burners. So for your admin people, if you're a business owner and you're not on the tools, guess what? You're a burner. So it could be admin. You might have an estimator in there. You know, that'll be admin. It could be, I know, your schedulers, your callers, if you have that function, all those people here sitting here. And guys, if you want me to slow down or go a bit deeper, let me know. Otherwise, I'll charge on in my rampage as I do. So spend a bit of time hammering this out. And there's a couple of ways that you can do this. And there are a couple of cues in this as well. So in this first section here, we just want to build out the individual. We're not trying to fill in every single column and all the rest of it. So it's just these beige color cells or yellowy color cells where we have data entry. That's the bit we want to hammer out. And everything over to the right is just calculations. So if you want to know how much a person costs you or whatever happens to be, that is over to the right-hand side. So, for example, you might have a casual staff member, you know, Daniel Wilkinson. You just drop them in there. I pay this poor guy, you know, 28 bucks an hour. They do 40 bucks an hour, and then it blows it out to the side. Now, if you have people on wages, so you can back a couple of these out and you go, well, look, sorry, you have someone on salary. You can just put down the salary amount and it'll calculate it out to the right-hand side. That's it. If you want to get pretty sophisticated with this and use this as a forecasting tool, and again, budgeting and forecasting is almost exactly the same. Budget's just a fixed period, a forecast is just a moving period. So don't let other people get on top of you or bamboozle you with that. You can say, hey, I want to add another $150,000 estimator, but they're not going to start until December. You're more than welcome to delete those numbers out. So this has a fair bit of portability in it as well. If anything gets a bit curly, I mean, just click and drag the formulas down. Worst case, you're welcome to give me a call. I'm not going to charge you for a 10-minute conversation. Reach out. We're definitely here to help. So once that's hammered out and built out, you'll be able to see what your wage costs are per month over to the right-hand side. And then all of this here. So just a refresher again, we've built out the overhead detail. And that rolls into the summary here. So you have your overhead employees and then your general ad hoc expenses. All of that feeds into the master budget over the side here. So you see here, there's wages and salaries. I haven't populated a lot of data for all these other lines, so I didn't really want to waste the time there, but you'll have heaps of data in this and go, well, right, lock this away, does it work? So accounting, bookkeeping by month, you get a bit of a snapshot as to how much your business is going to cost to run for the next 12 months. That's overheads. So hopefully that's fairly comprehensive. I'd strongly encourage you to jump in, have a play with it. There's lots of cues and prompts everywhere, all over this. And again, just rewatch this at 1.5 speed if you want to run this in parallel. But this here, I mean, there's nothing revolutionary with this either. I mean, it's taken a bit of brain power to put it together, but this is just pretty standard big business thinking. If you think about Telstra or any of the big players out there, all of them have a budget. And well, they must be big for a reason. Well, they use tools like this to measure themselves against and keep themselves accountable. Right, so that's the easy section. What I might jump to next is I'll probably jump into the commercial space. And in particular, I'll spend a little bit of time on this, but in the commercial space, it is actually very, very, very similar to building and construction overall. You have large lumpy payments. They're usually for a fixed duration. They're commonly fixed price, you know, pending provisional sums and all the rest of it. But you might come in and do the engineering on it, the pipe work, you know, I guess fire suppression system, wherever it happens to be, but it's a fixed price. So you're almost looking at a building and construction model. So if you are in that space, and just a hot tip, if you're not doing work in progress, your numbers are probably bouncing around like this. I strongly recommend getting involved in WIP. Highly important. It isn't just a tax entry for QBCC. I mean, it's critical if you want to understand your numbers. So if you're not doing WIP, there's a separate video on this, which we've done, I think about a year or two ago now. Definitely check it out. But I'll jump into this commercial space now. So we've sorted out the overheads and everything below here. Now we want to get into the meat, and I'll spend a bit more time in this section. So in the commercial space, we're just going to touch on revenue first. So I'm going to change gears and come across to here. There is a WIP link if you guys want to check it out. It's worth a look. We give a couple of tips and bits and pieces in there. Check it out, but it is part of the model. Our website has a heap of tools and videos, all free. Jump in, check it out too. So a couple of really important concepts as far as being a project builder or being a project plumber is, unlike the, I guess, the residential space or the maintenance space where you do a quote in advance and you might say, hey, the first hour call out is $220 and that's 180 or 170 thereafter. You know, the couple of hours rack up and you push it out, and you need to have sort of like a rolled up rate in there. So commonly with your rates for the residential side, you might have the wage plus super plus work cover, payroll tax. You might have a notional amount in there for unrecovered time for driving around point to point, because you might pay them for 8 hours, but then 5 hours is a billable work. So you want to try and build in some unrecovered time in there as well, or some unrecovered costs. You have a notional amount in there for cars, but it's a lot of spot sporadic work, high transactional volume, and a lot of volume overall. Projects is you need to bundle up. So here's the scope, here are the drawings, here are the plans, and you need to build out your costs. So you need to go, here are your wages, here are your people, here are your materials, here's the critical path for the job that's on site. Hopefully you have a decent set of plans, like a very decent head contractor. You know your critical pathway to build this, and you build in supervision, you build in, you know, a little bit of owner's wages, you build in all your materials, downtime, toolbox talks, all that sort of stuff. And you go, right, well, this is going to take 12 months to build. Now, commonly what happens out of that is two things. One is you can either do stage claims, which is, you know, once certain milestones are reached and a QS or a quantity surveyor walks around, QA goes, yep, send me an invoice. Or the counterbalance to that is that you'll actually have a percentage completion, and then you do monthly claims thereafter. So I'm in this budget build, I'm not going to talk about the impacts of WIP. That's a separate webinar, separate process. We're almost going to do a bit of a cash flow process in this document itself and just try and cash flow this out, and that's going to form the budget separately. So it's a bit of an unusual way to do it, but I think it's probably the cleanest way to do it. So this section here is broken up into two parts. One is so building a budget isn't last year plus 10%. I want to see signs, I want to see evidence, I want to see something to measure ourselves against. And I want to see our existing projects here listed out. So just the existing ones. There's a separate section here for blue sky or projects that are yet to start, but I want to see each project listed out, who they are, what's the name of the site, target completion, what is the GP percentage on these, and then I want to know what the contract price is if it's fixed. Now, if you get variations and stuff later on, you can add these down the bottom or add them up to the top, but I want to know what the value of these projects are. And because we're doing a July budget, we go, well, this project here is worth 1.25 million. And I go, well, hey, Dan, you know, I've done a bit of a forecast here. I think we're going to bill $150,000 out pre-June. Well, guess what? One minus the other, you've got 1.1 million to forecast out to the right-hand side. So some of these projects might go longer than a year, in which case you're not going to bill out the entire 1.1 million, but try and claim these out as best you can. So hopefully you have a very, very good schedule out ahead of you. I mean, that's your plan for your operations and your plan for your staff to execute on, but try and have a really, really, really educated guess as to when some of these plans might go out. So I've just done a really sort of broad flatline number here. You know, January, you're not expecting a claim. Builders, plumbers do a rush to December. You know, they try and, you know, squeeze a bit more out. January is a bit quiet. There's a big breath before February kicks off again, and then away you go. So list out the projects. The GP percent is super important because it's going to drive profitability and drive COGS or direct costs. Put in what the contract price is, excluding GST. So keep in mind, this is all excluding GST, guys, because you don't get to keep it. And the GST goes to the balance sheet, which is another conversation. This is all ex-GST. Just something really important to be mindful of. list out the projects, timing of claims. I don't mind if it is a little bit rubbery. And then particularly as you get into July or September, you can change and move these around. You might have a project that you thought was red hot that didn't land. Just delete it. You're not going to break it. So put in all your current projects, map it out, and they'll give you a bit of surety as to how much revenue you're generating each month. And then down the bottom here, this is where you start to do a bit of a blue sky, and we sort of exit out of budgeting and probably a bit more into forecasting. Put down the stuff that is signed that's yet to start. So this one here, target completion October, but it's not kicking off until here. Drop in some of these projects and do drop in a little bit of blue sky into this as well. You know, I've got these 4 or 5 tenders out. You can start to do like a bit of a what if. You know, hey, if all these 5 land, what happened if, you know, 2 of the 3 or 2 of the 5 don't land? You can delete them out and move them out and play with them. You can adjust the GPs in here as well. You know, what happens if I have to have, I guess, shave my pricing and drop to 25%? What does that do to the front sheet? So all this is dynamic, and it tells you in the bottom right-hand corner how much money you're going to make. So this does drive everything in the spreadsheet overall. So I think there was 613. So I just changed it by a couple of points. Then the margin we added in sort of 30 odd K worth of profit. So you can play with the sheet and go, well, and do a few what if scenarios in there too. So this section here is the easy section, you know, the revenue and all the rest of it. When it comes to the cost of goods sold for the commercial build, this is all formula driven. So you don't have to work out accounts payable runs and all the rest of it. So a budget isn't a cash flow. They are monstrously different. A cash flow is commonly pivoted off your balance sheet, whereas your budget is commonly pivoted off your profit and loss statement. So everything that sits on the cost of goods sold side is all formula driven. So you don't have to try and work out people and heads and claims because it is a project. You should capture all the project fees into one lump cost. How you sort of micro enter all those in, you know, that's on your side with your quoting and estimating partner. But you know what the costs are, you know what your margin is, you know what your revenue is, you know when you want the claims to land, you know how long you want the project to take. That's your P&L. So from the cost of goods sold side, it stays steady. Now, if you are a commercial builder, anything that sits up in COGS should be covered under a project one way or another. So you could have a revenue supervisor that manages 3 projects. Well, there's going to be a third of his or her wages buried in this. It's pretty rare to have someone up in COGS that isn't allocated to a project. So just be really, really, really mindful of that when you are job costing. So this is all formula driven, and all of this feeds straight into this cost of goods sold line here. So you can see here, August, $90,000, come back across to here, August, $90,000, and then this is the sum of all the above. So I've only got one project in there currently, and then similar to the revenue, commercial projects, nothing in July, our first one in August. I'm just going to come back down here. I'm just showing you how this works. You know, there's nothing in July, August, and that's how you know it all links and works back out. So as you can see here, we're hoping to make 2.5 million. The COGS on this are 1.75, and obviously there's some resi stuff in there, which is muddying this a little bit. But that's how that side works. So the estimating side's far more complex, but the budgeting side for a commercial industrial builder is a fair bit easier than the resi side. So hopefully that makes a bit of sense, and I might just close out the commercial side of this conversation just now, but I don't think there's any questions on that so far. Just having a look at hands up or anything. Yeah, great. All right, so that side's done. So if you don't do commercial, guys, park it. But if you want to get into commercial, the philosophies and principles apply to this. Now we probably get into the more complex side of this as far as the budgeting and the performance goes on the residential side of things. So we're going to gloss past these 3 tabs now and go straight across to the resi maintenance side. So there's a couple of really important parts on the resi side with this, and I've had a fair bit of time in labour hire, but essentially a plumbing maintenance business, most materials, is just a labour hire business. So what you want to do is that you want to charge an hour, you want to pay an hour, and you want to keep an hour. That's the philosophy I talk about. And you go, well, if I'm paying someone for 8 or 10 hours a day, I'm probably only going to charge them for 5-6 hours. And there's a whole pricing and profitability calculator separate to this, but we need to build in some assumptions around, well, what are their wages? Are they on a salary, or are they paid hourly? In which case there's time and a half and double time consequences in that. But then also, what do we get to charge these people out? of as well. And then what is their utilization rate too? And I'll talk about that shortly. So what we're building in this section here, this is just the employee base at this stage. So in this instance here, we want to, and then similar to the overhead section, we just want to list out, Daniel Wilkinson, Phil Brown, list these people out and go, well, what's the hourly rate? And you should be able to get that straight from Xero, MYOB, QuickBooks, whatever platform you use. And a lot of you will know a lot of these numbers off the top of your head and go, right, well, this person's 45, they're 35. There are penalty rates, obviously, in plumbing. This isn't all encapsulating. So if there are allowances and all sorts of other stuff, I mean, they're pretty immaterial in the scheme of things. We haven't built an allowances section into this. Just try and roll that up into the rate here. It doesn't need to be exact to the cent. If you're fluffing around with cents in any of these documents, don't. It's a waste of time. It's immaterial. So if you pay someone a travel allowance, that's, I don't know, $40 a week, just lift this by an hour. Pretty simple. Keep it simple, keep it basic, don't overcomplicate it. So once you build out your employee base, and then these are just the earners. So employee one, $45 an hour. This will then calculate out the penalty time. And then over to the right-hand side, because all you need to do is enter this figure here, what's their base rate, and then you'll see here there's calculations that happen in the background. Out of this, we want to get a really firm hand on as to where their hours are split. So what I mean by that is that you might have someone whose base rate is 45 an hour, but they just might do emergency plumbing work all day, every day. In which case, they're not going to get paid $45 an hour. They're going to do call outs and night works and all sorts of stuff. In which case, well, guess what? That drops to zero, and this might drop, jump up to 35, and there might be sort of 8 hours here. So just make sure you give that a bit of science and evidence, and it is a rule of averages too. It doesn't need to be exact and to the nearest decimal. This is just a guide. This is a roadmap. This is a plan, and you're going to measure yourself against that over time. So spend a bit of time, I guess, dropping the employees in. I've only dropped them down to 15. If any of you on this webinar or in future webinars need more, just reach out and I'll drop a few more rows in, but I just wanted to keep this file pretty compact. So list out your employees, drop in their base wage, drop in their spread of hours based on ordinary hours, time and a half, double time. Just be really, really, really careful about that. And then what we've done here is we've built out the employee cost base. Now, a little bit further down as well is that, and this is hidden down a little bit further in the spreadsheet, just make sure you drop in your current superannuation rate too, because you do pick up all the on costs in here. So I think it's about 11 or 11.5% at the moment. We'll just need to confirm that, but you'll probably know, or your bookkeeper will know of the superannuation rates. And then just make sure you drop in your work cover rate as well, because this is still a sunk cost for every hour that the employee works too. So just make sure you update that as a once over. This gets refreshed every year. And yeah, I mean, it's not hugely important, it's pretty immaterial, but make sure this is right, because it's easy to give away a couple of dollars here and there as well. I mean, as an example, I mean, if someone's on, 10 or 11% here and you're paying them $40, $45 an hour, I mean, the business is paying an additional, probably $6 an hour per hour worked just in these two on costs. And we haven't even added payroll tax in or any of that other stuff in there either. Annual leave, sick leave, all that sort of stuff if you do pay those. So we've built out the employee cost base. You're pretty happy with it. You've checked your hours, et cetera, et cetera. Spot check them against, I guess, previous payrolls too, because we have got wage calculations in there and a few other bits and pieces by week, and it does roll across over here to the side. So you can see what your anticipated payroll is by month as well, and they are driven by days in there too. So you can actually go to the bottom and go, is that my actual wage bill? And just cross-reference that against Xero to see, to crap check these numbers, and there's nothing too wild going on. Now, the tough one, this would technically be a whole nother session, and there is a pricing and profitability calculator if you want to try and roll up rates and vehicle hours and all sorts of stuff in the background. I've tried to keep this one fairly generic, but what we're trying to do here is that we're trying to build up the charge rates for the individual. So the people are going to go out, they're going to work their 10-hour day or 8-hour day. You're not going to charge 8 hours to them unless they're working on one project or doing a septic install or something like that. But the law of averages is that if you're a maintenance plumber, you're going to be productive for 5 or 6 hours a day, maybe 4 in there as well. So what we want to build into this is that for each of these employees over to the left, you want to build in what their charge rate is. So commonly I see, $220 for the first hour, and then it sort of delineates after that. I'll probably pull in the smaller charge rate first, and then anything above and beyond that is cream, or you can average that out too. They go, well, look, our base rate's 110, time and a half's, I don't know, 165. And if there's emergency call out work, it's, I don't know, $235 or something. So populate those in. This one here is probably one of the most important drivers on the spreadsheet. So this is the utilization rate. So say, for example, you have someone that's working 8 hours a day. You only get to charge them out for 5 hours. You go, well, what's my utilization rate? They're only productive for 62% of the time, 63% of the time. So you need to have a really, really, really good handle on that. So as far as like planning and scheduling your jobs, we only service this area on a Tuesday and Thursday, whatever it happens to be. If you're having people go from point to point to point, you'll be tearing up a lot of cash, excluding emergency stuff. But just get really, really conscious about that utilization rate. I paid this person 8 hours a day. Did I get to charge 6, 6.5, 7? Because you squeeze out an extra half an hour a day times 260 days of the year times 4 or 5 employees. It is a monstrous amount of margin you add into the business. But separate chat around that. So be really, really, really conscious of utilization rates. I mean, you probably should be chasing around that sort of 65 to 85%, depending on how sophisticated you are in the business. Regional stuff's always going to be hard. Lots of areas, lots of kilometers, in which case, well, if utilization is low, guess what you need to do to your rates? Increase them. So we spent a bit of time around the utilization rates. We know what our charge out rates are. Hopefully you have a rate card for that. Different employees are charged at different rates, et cetera, et cetera. Now, all of this here will roll into the master budget side over here. So the income is going to roll into here based on the income in the other tab for the labor revenue. And if you're good at Excel, you can follow these formulas back, but it does roll up, and I've checked the formulas. If you have anything curly, reach out, guys, happy to help. And then down the bottom is your cost of goods sold, which would be super, wage, work cover, payroll tax, et cetera, et cetera, et cetera. Don't be scared of it. Just give it a crack, have a play. If anything breaks, close it down, open it up, and just have another crack at it. Reach out if you have any questions. But that's the labor side. Hopefully that side works. Now, this section's a little heavier, and apologies for the assault of numbers here. But I think here, to your point before, you were talking about markup and materials, percentage of labor, and a few other bits and pieces. So I've probably gone a bit bonkers here, but bear with me. I've separated this into a couple of different areas. So in this first section here, I'm going, well, here's the revenue that is driven in by by each employee. And it's there just as like I guess a point of reference, or I guess a pivot point in there as well. This is the revenue side. It is all driven by formulas. So this here just tells you what your revenue is on your employees and your materials. So this tells you gross revenue by month, by month, by month, by month, by month. This section down the bottom here, this is where we start to get into a little bit more detail. So the way we built this, and I have a lot of conversations with plumbers, they commonly say, well, how do you forecast out materials and how do you forecast out labor? Well, labor is easy materials. And they say, well, when I look at my average jobs, materials are generally 30% of labor, or materials are 50% of labor, whatever it happens to be. So I've just taken a bit of a generalist view here, and there's notes and comments all over the place. So you can hit this little plus and it tells you how these formulas drive. But I promise once you use this once or twice, it'll be a lot easier to use. So I've just tried to keep this a little bit simpler. I've gone, well, if you know what your materials are as a percentage of labor, so commonly it might be 40%, this here will calculate what your material cost should be as a percentage of labor. That's how that section works. So if it's commonly 30% or 20%, you might focus on septic installs and hot water systems for new builds more than emergency plumbing. That there will change quite considerably in the background. So play with that number. If you hate that number, just override these cells. Because if you change this, you can sort of see where the numbers change overall. You're more than welcome to override it. You won't break it. If you hate using that and go, no, Dan, I want to just do it manually, make that 0. And there's an ad hoc materials line here. You can put in whatever you want down the bottom there. It's just a flat entry number. And I'll tell you what's going on there. And then in the background as well, we talked about it before, where we've built in the costs now here. So we've got either materials cost of labor. So I'll just change that back to 30%. You might have some ad hoc stuff in there that you don't charge for, or I don't know, you might want to have a fuel line in there or whatever it happens to be. It's like a bit of a bucket you can drop in pooled stuff. And then we go, well, how do we make sure we get our revenue on materials? That's where this comes in. And we touched on this right at the start of the chat. So whatever your average markup on materials are, so materials only, you drop that in there. So you could have on average a 50% markup, or you could have a 200% markup. You'll notice that it changes this line here. So it drives out the revenue line for you. So you got your costs, you got your revenue, and then you get your GP out at the bottom here. So just to reiterate this one, this is for this is for materials only. And you drive it by either doing materials as a percentage of labor, because I hear that, I guess that commonality out there a lot. And then what's your markup on materials? So it depends on what you sell and what you do, but I mean, commonly it should be about an average of 100% markup. That's ideally what you want to chase. I mean, you can't get 100% markup on a $10,000, $5,000 hot water system or a 20,000 septic install. You know, obviously that will need to come down. But if you're a typical maintenance call out emergency care plumber, it should be at least on average 100%, if not a little bit more. So when you are entering all these into, the biggest litmus test of this is going, are there any big red nasty numbers here? Are there any silly numbers in here that say like 10% GP? You want to make sure that this line here is at least 20% or better, especially in the maintenance side as well. So if you're getting sort of 30s and 40s in here, we know that this is on track. If you've had a fat finger somewhere and you hit 1%, you can see that a fair chunk of this does plummet overall in that too. So just be really mindful of those drivers in there. The final piece, and this is just completely data entry, contractors. Really simple, contractor income, charge the client, contractor cost. If you don't use any contractors, zero them out. If you use contractors, just drop them in. It's just all data entry in this section. So you might have overflow work, you'll tag someone in, just drop them in.
Hey, Daniel, can I just ask another question? I do apologise.
No apologies, mate, please.
If you go back up to the top for me, I just want to confirm where you're talking about materials as a percentage of employee revenue. The employee revenue is what you're charging the employees out at, not at what their cost is.
That is a good question. Let me just double check that just so I don't give you a furphy. Yeah, so it's a cost. So it's a percentage of labor cost.
Yeah,
on this.
percentage of a labour cost. So labour cost is actually what you pay them, not what you charge
Yes.
them out at.
Exactly
Okay.
right. Exactly
Yeah,
right.
okay.
So
labour cost.
exactly. So the labor cost here is 11 grand. So keep in mind this just drags off this other sheet here.
Yeah. Yep.
And then you go, well, commonly, you know, materials are 30% or 40%, whatever it is. And that will then change this figure because the formula is going labor cost times 40%. There's your 4 grand.
Yep. Perfect.
And that feeds. Yeah. If you guys, no, pleasure. If you guys want to cheat and sort of see how these formulas are dragged in, commonly in Excel, if you click in any of these cells here and go, I wonder where that cell comes from, and rather trying to follow this through, if you click in these cells and then click up here in the bar, it'll actually highlight where the cells come through instead of trying to figure out, you know, where to look and all the rest of it. So just a hot tip there. So in the Resi space, we've mapped out our employees. We've got our base rates right. We've got our spread of hours right. Utilization will be the hardest one for you guys. If you don't have utilization reporting your business, I strongly recommend it because this is commonly the biggest bleeder of gross profit in plumbing businesses I see. Utilization rate. Charge out rates are right. We then jumped across to materials. We're comfortable with materials. We know what our markup is on average on materials sold. We know what our percentage markup is, our percentage of materials to labor, because that's another cost revenue driver. Happy with this. Talked about it internally. We've got some contractor charges in there. And we go, right, well, what does all this mean? So we are a blended commercial and industrial business. We jump across to here and we go, well, how does a business look? So we've got our commercial lines, we've got our commercial income. Again, you can see where some of these formulas drag from. Labor, materials, contractor. Over to the side here. Labor, revenue, contractors, employees. So that all links back and go, well, where is our GP sitting? Now, this one's probably a bit harder to look at because on the commercial side, I mean, depending on the size of the project, if you're working on a $50 million project, margins come down, but generally as a rule of thumb, about a sort of like 20, 25, 28%. And then your resi stuff, septic tanks and all the rest of it should be chasing around about sort of like 40, 45-ish in there. So the blended margin looks about right. You're welcome to sort of delete these out and get a bit of an isolated view and go, okay, well, what's our resi side doing? Oh, that's amazing. It's 45%. Dan said, 45% is probably getting close to rockstar territory, to be honest. So you can just drop those back in and go, well, we're going to make $902,000 in gross profit. The bit I care about most, probably more than the dollars, and I have this conversation with my clients all the time, is what's your GP percent? Because GP, gross profit, pays the bills. Most of my clients now, and again, I'm just trying to train this way of thinking, is a lot of my clients go, hey, Dan, I won this project. It's going to give me X GP. I just could not care about the revenue. What I care about is the quality of earnings. So really, really, really put this line under the microscope because it tells a really powerful story around quality of earnings. But when a dollar comes in, how many cents do you keep? You've jumped in, smashed in other income, apprentice rebates, whatever it is. Now we sort of start to scroll on down and go, does this business model absolutely make sense? So what I probably should have done, guys, and apologies for this, but I might just drop in some dummy numbers here, is we want to make sure that our overhead percentage, now, if you're in the commercial space, this overhead percentage needs to be single digits. If you have a business that's running at a 20% GP and you have overheads running at 15%, so you're keeping 20 cents worth of gross profit and you're spending 15 cents in overheads and you're making 5% at the bottom. So keeping 5 cents every dollar, it's not a good business model. So if you're in the commercial space, you have to be, this overhead line here has to be 10% or less, ideally 8. That's rockstar territory. If you're in the residential call-out market, maintenance market, your GPs are running at closer to 40. You probably want your overheads to run at about 15% because you're going to have a bit more overhead support in there. So admin and scheduling and a few other bits and pieces tech. So then one minus the other is hopefully you're making about 15% at the bottom. So you guys here on the call, your measurement of success is this far bottom right-hand corner here. When the dust settles and costs and cash fly everywhere, this here needs to be at a minimum across the board, 10%. So you guys as owners need a 10% return on your business. Resi space, rockstar territory for commercial guys is 12 to 15. It's rare that I see that, but we got a couple. And then in that maintenance call out section, 15% plus. Anything below that, and you're doing yourselves a disservice.
Okay, sorry, mate. Can I just confirm?
Please.
Overhead target
Yes.
percentage of business 15% for maintenance.
Yes, or better. Yeah,
better.
that's like
Yep.
upper limit. Yep.
Yep. Net profit margin target for maintenance business is 10 to 15%, but up around the 15.
Yes.
Okay. GP target 40%.
Yes.
Materials markup target, you want to be averaging 100%.
Yeah, depending on the mix of business, yeah. And that's
Yeah.
a bit of a generalist, but yes, yeah, correct.
And they could form the basis of your KPI drivers then.
100%.
Okay.
Definitely. Yeah, absolutely. So I mean, there's a million ways to cut this. I mean, if you do more septic installs and big stuff, I mean, your material markup drops, but then you just have to sort of tweak, labor and rates and all the rest of it. So you can pull a couple of levers in the background to make sure when the dust settles, you guys are getting at least a 10% return in the bottom right-hand corner. So, and keep in mind that's after you pay yourselves a wage. So if you guys are working in the business, this isn't just total, owner's take home. You're paying yourselves 120, 150 in the background, and then you as a shareholder get a double dip. No difference if you have shares in Telstra or whatever it is, you're CEO and shareholder. So you need to make another 10 to 15% at the bottom. Now, if you're not, so say, and I wouldn't mind us pressure testing this before we get to questions. If you're not, you need to go back to these tabs and go, well, where are the problems? And you start working backwards. So you might have 15s and 20s all along here, and then it falls off a cliff. Well, guess what? You're probably short on commercial work, in which case you need to drop in 200K here, 200K here, 200K here at 30%, and go, Jesus, if I put my sales hat on and drop this in here, does this work? And that's how you start testing. You get this feedback loop in place. What are the levers I need to pull to make sure I get 10% out of this business? Or you might say, hey, my overheads are too high. These are sitting at 15%. What do I do? Well, there's two levers. One, you cut overheads. And most of you guys are probably already running pretty lean. So what you need to do is jam in more revenue, more profit. That percentage diminishes. So there's a couple of levers here you can do, because you might jam it in, spend hours on this and go, I just can't get this model to work. Drop in another head, see what happens. Drop in another head 4 months' time, see what happens. Do it for a year, normalize the business and go, if we had everyone sort of steady and able, what does it look like? That's how you start to use a really good budget model. And if you get really stuck, and apologies for the plug here, you give me a call. That's how it works. So we covered a tremendous amount of ground here. I hope everyone got a lot of value from this. I'm just going to go back probably to the PowerPoint presentation again. But any questions just while I change gears a little bit here?
No surprise, I have one.
Please.
I do apologize again. If you were giving us some advice, and I like the idea of the targets and the KPIs because it gives us something to focus on, right?
Yes.
But if you were giving us some advice, what would you recommend as a time or a target we should be spending on our business looking at this stuff a week? Because it's really easy to get caught up in the business, right? It's really easy for us to get caught up in the day-to-day churn, emergency things happen. But if we wanted to set ourselves a target and say, right, I am going to, from this week on, spend this much time investing in this part of my business, what should we be trying to allocate?
Really good question, Heath, and I'm going to give you an answer with a couple of asterisks, so apologies, because it's not quite a one-size-fits-all. I mean, when you're sort of smaller and leaner and kicking off, you are scrambling. I sort of call it seagalling. You take anything for any price for anyone, and you scramble and you build and build and build and build and build. Then you find a unicorn, they give you a bit of relief, then you can sort of start working on this business a bit more. So if you're in startup, sort of sub $1 million, you're probably going to find that maybe sort of 5 to 10% of your time's on the business. But as you sort of get, I mean, depending on commercial versus resi, I mean, if you're in the commercial space and you're sort of 2 million plus, I'd probably encourage you probably at least 20, 25%, to be frank. Because if you're at that bigger business stage, you no longer own a job, you own a business. So when you're smaller, 1 or 2 plumbers, you own 30 jobs a week, whatever it is. When you're a big business, you're no longer you're less on the tools, you're more in the back office, you're wheeling and dealing, you're more owning a business than a job. And then in which case, the bigger it gets, you need to build a machine under you that ticks along with sort of minimal input and involvement in the day-to-day. So depending on the size, Heath, I'm happy to have a separate conversation with you, mate, but I'd be aiming for about sort of 15, 20%. Just to let you know what I do, I mean, because I'm a partner here at Exact, I look after CFO advisory. I've got an amazing team under me. I do Saturday mornings. My partner loves to sleep in. I get up at about sort of 5-ish, and between 5 and 9, that's my on the business time. I don't turn emails on. We use none of that rubbish. I go, right, I'm going to build a financial model for the next team I'm having, or I want to do investigation into, I don't know, like a engineering section in building construction. How's engineering going? Is there an opportunity to build another pillar under our business in there? How do I build synergies between us and tax? So phone goes off, emails go off, and Saturday morning. So I'm probably less a percentage. I'm more every Saturday morning between like 5 and 9-ish. That's my spot. Cool.
Thank you.
No, pleasure. I've flashed this up, guys. It's going to come out to everyone anyway. So this is the QR code for the tool. Free, available. Our website has a fair bit on there. I'm just going to flick across. I'll give you guys another minute or two to scan that if you want. If you've liked what I've talked about here, if you want to have a bit of a one-on-one session with me or my team, but you're probably going to get me and you want to talk about the bits. So Heath, I'm probably looking at you, mate. There's no charge or anything. You want to go a level deeper, get a bit stronger than that. I mean, with our associates with Master Plumbers, we give out an hour free advice anyway to everyone. If you want to lean into it, I'd highly recommend doing it and just pick the brains. Yeah, so here's the second QR code. If you take it, great. If not, we'll probably see you at the next event anyway. Okay.
Hey, mate, that was great, Daniel. Thank you.
No, pleasure. Any final questions?
Yeah. I haven't seen any others come in, but if anyone has any, feel free to raise your hand or just jump on the microphone.
Yeah, it's
or put them in the chat if you're shy.
It's probably really important, guys. I mean, we're all in the same field, have the same aches and pains. So I definitely share what's going on. Again, not trying to sound arrogant, but there are some pretty big brains on here. So not me, but there might be some other war stories we can share quickly. What about this? What about that? Otherwise, if no questions, all good.
I've definitely asked my fair share, so I'm going to shut up.
No, I love
it.
your lean in, mate. I love your lean in. It was awesome. Thank you.
Cool. All right. Well, yeah, if anyone does have anything, feel free to speak up, but I'll wrap things up. But yeah, thank you so much.
So I'll just sort of jump in. Summer, we're going to do a quick shout out for the other training sessions that are coming up that we're helping out with.
That's what I was just going to do, Phil.
Oh, sorry, Summer.
Getting excited. Jeez,
jumping in. Yeah, thank you so much to Daniel for being here. Thank you to the team at Exact Accounting for helping us with these. So all these sessions that we're doing with Exact Accounting this year, they're all part of a CSQ small business funded program that we're running. So as Phil mentioned, we do have a couple of others. Some of them are face-to-face. Specifically, we've got an end of financial year tax session. That one's a face-to-face one on the 15th of May at the MPAQ office. And then we've got succession and exit planning as well in August. So there'll be info about those sent out and up on our website as well. So we'd love to have you along. Succession and exit planning is a big question that we get from a lot of business owners as starting to get towards the end of their careers and things like that. So what to do and how to plan for that in your business model. So
I just think
Rachel,
on that one too, Summer, the exit and succession, absolutely, what might happen towards the end of your career in the industry, but also as a crisis plan, in the worst case scenario too, so that you've got, a clear succession plan for if you're injured or can't carry out the work and run the business, who's going to look after that, and you're not making those plans at the worst possible time to be doing it. It's all kind of ready to go, and all the key people in the business have agreed to it as well and have some view on that.
Yeah, absolutely. And Rachel asked about the QR codes. So yeah, they will be, Tracy will be sending out an email, I'm assuming, post this one. So that'll include the links to the budgeting tool and to any other information. But yeah, we'll finish nice and promptly, 9 minutes early. Good job, Daniel.
Thanks.
If anyone does have any other questions, obviously we can pass those on to Exact Accounting. And yeah, hope you all enjoy the rest of your day. Thanks for coming.
Thank you, everyone. Talk soon.
Thanks, Summer. Thanks, Tracy.
Love your work. Bye.